During periods of high market volatility, clients want to participate both on protecting their portfolios, but they also want to be part of the upside. Clearly, markets that we are experiencing today show exactly that. Deep losses followed by massive returns. So those are tricky markets to navigate. So Mike, we're here today with you. How do you compare this period of market volatility relative to prior periods?
I mean, clearly the tariff issue is having a macro implication for volatility, higher volatility as a result of that. But that's not the end of the story. There's a lot more to it under the hood. There's a micro side as well. And one of the really interesting facets of today's market is that retail participation in the market is making the market, call it more jumpy. It moves on a relatively smaller dollar amount of flow. The price moves even more extreme than it has in the past. So that we have more retail ETFs, we have more emotion that's involved in markets today than there was 10 or 20 years ago. And as a result of that, you get a higher frequency and severity of these volatility shocks like we've seen over the last several months.
Different market conditions this time. Clearly, participation from retail investors, as well as new participants like exchange-traded funds being a big part of the market. So considering these fluctuating market conditions, how do you play these markets, Mike?
Yeah, one way to approach this market is to think about a higher quality, lower volatility orientation to your equity allocation. So when you think about what happens in a volatility event, a volatility shock, typically markets are in a big drawdown. But higher quality, lower volatility stocks tend to mitigate some of that downside. So what happens is the market tends to draw down. There's a flight to quality. Higher quality, lower volatility tend to have a better performance historically. When markets rebound, which is faster and faster these days, those same high quality, low volatility stocks that help to mitigate some of that downside risk participate a lot in the upside. So having that higher upside capture, lower downside capture can materially add to the performance of your strategy.
That's excellent. And within our portfolios, in the high quality, low volatility portfolios, how have we done?
So Q1 of this year, these strategies have outperformed by about 500 basis points. Now that's a short-term number. Longer term, these strategies have actually kept up with the market. They've achieved about 99% of the return of a core benchmark. So it's about, again, risk mitigation. That's the objective of the strategy, but participating on the upside as well. Having that lower downside capture, higher upside capture allows you to mitigate a lot of that risk, but participate in the upside of the market as well.
Thank you, Mike. Thank you for your insights about high quality, low volatility strategies.